Hello guys, welcome to the final lesson on the weekly range profile, and in this one we're going to talk about the one is the weekly stop run reversal, buy or sell. Now this is really straightforward with unlike the other weekly range profiles. In this one, the market usually will see minimal delivery on Monday and Tuesday. Now this usually will occur if we are at an high time frame level, a key high time frame level of liquidity, or if we're near a key high time frame level of liquidity. Now, I know I have all the diagrams here, but let me just draw it out conceptually, which I like to do because that helps me communicate the concept behind this across. So, what would happen is we would have some form of longer term buy stop. So this example, we're going to use a buy stop, and then the market reverses down into level of discount, for example, and then it starts to rally, and then we already know that there's buy side liquidity resting up here, and that's where the market obviously is reaching for, because as the market is expanding away from discount, it has to go for buy side liquidity. Now, as the market starts to expand in price, okay, what it will do is it will get very close to that liquidity and then consolidate a little bit. Now we know, because this is a long-term high, the liquidity resting there is not just retail liquidity. Now when I say retail, I mean the funds, okay? But now sometimes when I say retail, I also mean retail like you and I, or retail, okay? But here we have long-term institutional liquidity resting above the eye here, and the market will get up into that old eye there and just fall a little bit short of that, and then retail will view that as resistance is holding. So they're looking for the classic, is a U-curve pattern or M formation, and this is typically what retail will expect, okay? Resistance, you're looking for a run lower, and that's what you're anticipating. Now what usually would happen is the market will go into a little bit of a squeeze. Retail will view that squeeze as the market is respecting resistance, and the market should see a displacement lower. And what the market usually does is the market will run aggressively for the buy stop and then reverse. And a lot of times it will do that on a Wednesday midweek, okay? And just unlike the classic signature profile for Friday, which is the last lesson we talked about, where the entire week consolidates and then late Thursday going to early Friday, just an aggressive run for one side of the liquidity. With this one, the liquidity we're focusing on is not intra-week liquidity. Now, unlike Thursday, midweek consolidation, Thursday reversal, or Monday to Thursday consolidation, Friday reversal, with the Wednesday weekly stop and reversal, we're not looking at intra-week liquidity. So we're not concerned with the high of the week or the initial low of the week prior to Wednesday. We're concerned with what long-term fund level liquidity is near current market price action. What the market would do is the market will aggressively run for that midweek, and that's where it will make the high of the week in a bearish scenario or the low of the week in a bearish scenario. And this is a run for a long-term to intermediate term low or high, and it is categorized by the speed of displacement. And then as the market runs for buy side, squeezing in all the retail who think this was the top of the marketplace, that sucks in new longs in price. New longs in price creates a pulling of sell stops in the marketplace. So just by doing one movement, squeezing, running aggressively one direction, we have engineered and then neutralized liquidity. So that's the concept here. And I'm going to remove this, and you can see for the bullishness, on Wednesday, the market shows an aggressive run for high time frame sell stops, and then reverses going to Thursday and Friday. And then for bearishness, the market consolidates on Monday and Tuesday, shows an aggressive run for high time from buy stops, and then reverses going to Thursday and Friday. So we don't need all of this, and we just need to go and look at actual data itself. And the data we have here is from March, okay, which is I think 2 months ago. Now here we have a high time frame low there, daily low here, and also this data rejection block there. So let's just draw both of them out. We have a data rejection block here, which we never trade out into. That obviously is the liquidity we're targeting in price. And you can see we displaced high already, right? So we came very close down into this down candle. We displaced high already, and you can see what happened on Wednesday. And usually that move will shock everyone. That is characteristic of this type of delivery. Now, it's not every time it occurs, okay, but when it does happen, it tends to surprise everyone. It catches everyone off guard. Like, what caused this type of economic release? You can see this is not a result of FOMC or nothing. It just looks like out of the blue. It's just, if you measure this decline lower, it is 126 pip run lower, right? And look at this. So let's look at this specific day, which is 15th of March. So let's see what economic release allowed for that extreme. 215 pips on euro in a day is a lot. You don't see that with FOMC. You don't see that with NFP. Okay, that's a lot of pips. On 15th of March, what we had was core PPI numbers, core retail numbers. Okay, that was 1:30, right? So 1:30 for me, for you is gonna be 8:30 a.m. Eastern, and you can see the move starts before 1:30. This is 1:30 here. Okay, this is where 1:30 starts. Before all of that economic release, the move already started. So you know the move is not as a result of an economic release, and that's the difference between Thursdays, the midweek consolidation, Thursday reversal, or the signature profile to Friday reversal. That's the difference. This is not economic calendar based, and that's why we're not using intra-week stops to gauge this run. It is going to be higher time frame stops. That's what the market will do. This, so you can see what the market does on Monday, right? Oh, sorry, this is Monday. So on Monday going into Wednesday, what we have is we have a little bit of a consolidation. All right, the market is neither trading higher or lower. On Tuesday, we have consolidation again. And then on Wednesday, the market initially runs higher, looking like, okay, we're making new highs here. No one at this point is thinking bearishness. And all of a sudden, the market just tanks for sell stops. What is it reaching for? Not just the slow here. It's reaching for that daily sell side liquidity. And after the market reaches for that daily sell side liquidity, guess what the market does? Displaces higher, retraces back down to discount, and then if we use the replay tool, look at the after effect of this. Look at what follows through. Continues to buy because the manipulation is already done. We've done all the manipulation. So on Thursday, usually it can go into the marketplace looking for longs. On a Friday, you can go into the marketplace looking for longs, and that's your profile. We can use another one, right? What's the most recent reversal, long-term reversal we had in the marketplace? What's the most recent one? We have one here. Okay, so we have a long-term high up here. And then we have this one. This was the high that started out the decline lower. So now let's look at this week. Let's look at Friday. Okay. And you're going to see this is Monday. We have a little bit of a consolidation. Tuesday, we have a small decline, but still a consolidation. Why is it consolidation? Because this is where we opened up and this is where we closed. So it closed relatively bullish, but you can see the market runs higher, runs lower, then runs higher. It's not really doing anything. And then on Wednesday, the market just starts to run aggressively above that old high there. And then on Thursday, now you're looking for sells. On Friday, you're looking for sells. So now, in weeks like this, your setup comes on Thursday and Friday. Okay, not on Monday and Tuesday. It comes on. Now you can still trade that initial aggressive run for that higher time frame stops, obviously. And sometimes I usually will catch that. And if you catch a move like that, it usually is not going to be based off the economic calendar. It's just going to come out of nowhere, and you'll be like, "What's going on?" So if you look at this delivery on Wednesday, it's not as extreme as the other one I showed you, but it's almost 100 pips of delivery. Okay, on Wednesday going to Thursday. If you looked at the previous week where we made the highest high prior to the run lower, okay, after this high, we don't go above this, and we've not been above this high since 26th of April. If you look at this high here, and we go back and look at the previous week's delivery. If you look at the previous week's delivery, that's that old high there, that long-term daily high there. Then we have a shorter term daily high up here. Now look at what the market does. This is Monday. So Monday we have bullishness in price. Tuesday we have bearishness in price. So if you took the range from Monday and Tuesday, what's it look like? It's a consolidation. Why? Because Monday opens up here, Tuesday closes up down here. There's no change in delivery. It runs higher, runs lower, and then on Wednesday we see extreme upside. How many pips? 129 pips. Runs higher. And now here, everyone is chasing the longs. Now, initially, everyone was thinking, oh, this is resistance, so the market should sell off. So retail is shorting. No one is thinking the market is going to see extreme upside here. That the market aggressively runs and neutralizes buy stop. And now everyone flips to bullishness. And guess what happens? Then you can go into the marketplace looking for your sells on Thursday and Friday based off of the delivery on Wednesday. So on Thursday, New York's London session, we have a small little fair value gap here. Market goes up there, offer sells. If you missed that during this is New York session, we have sells from the bear shooter block. That's your sell right there. Target liquidity down here on Friday. You have a chance to sell off that old high there, which is a premium rate. That's an item from premium. You can see the market trades up into that London session. This place is lower, and then during New York, we have a small little reversal in price. So with this kind of profile, usually Mondays and Tuesdays are no-go areas. You don't go into the marketplace and trade Mondays and Tuesdays. Your opportunity for a setup or an execution is looking at that initial run for that high time frame stop on Wednesday, or the reversal play on Thursday going to Friday. Alright, so that's going to be all for the weekly profile. That's all the weekly profile we have. And on the next lesson, we're going to go into the market maker manipulation templates. And that's a new topic entirely that we're going to be covering. So I'll see you on the next lesson. For now, trade safe. And I'll talk to you on the next one.